Hello, investors. Welcome to one more monthly interaction with Canara Robeco. Last month has been an eventful month, both from domestic and global perspective, and we'll discuss that in detail over next 10 to 15 minutes. We broadly will cover the global macro, the domestic macro, most importantly, how the earnings picture is looking like for this quarter and coming quarters, and lastly, valuation view and how our portfolios are positioned in this market. So let us start with the global picture first. The global picture clearly has remained largely equally complex. While there seems to be green shoots in terms of the trade talks that are happening between US and China, as well as US and India. In both these trade talks, there is expectation that at least particularly in case of India, US trade talks, there is likely to be an outcome in this month or next month. That's what the general consensus expectation is at this point in time. With China also, the dialogue has started from US side. So it gives a little bit of a comfort in terms of the disruptions that we have been facing on tariff front for some time. But there has been just too much of to and fro, and so taking a call on this thing clearly is a difficult thing to do. Having said this, these tariff related complexities and effective 15 to 18% tariff by US on the whole world clearly has created a situation where the internals of the US data points have been weakening gradually. So whether it is consumer demand, credit card outstandings, in terms of the internals of the GDP growth rate, which are clearly propped up by just the AI part of the economy. The rest of it is actually moderating. So our sense is the moderation impact on the US, particularly which is visible in the labor data point, employment data point, is clearly visible, and that's likely to continue for some time. The inflation data has been benign in US, and that's where this clearly expectation that after a gap in coming weeks, you are likely to get the next interest rate cut. That's the consensus view. Our sense is we'll get one more interest rate cut at some point in time or next 3 to 6 months, apart from the one that is likely in the immediate FOMC meeting, which is scheduled this week itself. So that's the broader consensus in terms of interest rates. In terms of the implications of both tariff related complexities as well as the geopolitical complexities, which is again receding, it seems, in terms of the dialogues that are happening. The implications have been largely consistent over last few months, and we have been alluding to them in virtually every conversation that we had with you. The first is when there is this kind of complexity and this kind of disruptions, it leads to demand slowdown. And US was the largest growth driver for demand. So global GDP growth rate or US GDP growth rate, European GDP growth rate has been moderating and is stabilizing at a lower level. X of AI. AI clearly is something that is propping up, particularly the reported numbers in particularly US. But that's one. Second is it clearly has a correlation to how investors will look at the US versus the rest of the world. And we have been actually votary of this thought process that eventually the investors will look for other avenues apart from US to invest, given the way US policies have been over last 1 year, clearly in this administration. Uh, Although it has not played out yet, but when you look at the numbers, gradually it has started playing out. The emerging markets in general, actually, on an index basis, has outperformed US for the first time after a very long period of time. If you look at last 10, 15 years data, this is the first time, at least 10 years data, clearly this is the first time where it is visible that the emerging markets have started outperforming the US market, despite AI being such a large component of how US market has done. X of AI, US market has been far more basically normal than what it meets the eyes. So that's how the global piece is. Clearly, complexities remain there. Seems to be receding on tariff side, geopolitical side. Growth continues to kind of remain sideways. X of AI. AI is something that people are excited about. We think that while people are excited about AI and there is a lot of investment that is going on that side, uh, there is going to be lag in terms of monetization of these AI investments, and at some point in time, there is a disappointment which is likely to come to fore when people have discounted so much of things in the stock prices particularly related to AI companies with globally. Second, as we have been saying, basically that the largest capital flows have been going to US, and capital will look for the other developed markets, emerging markets, to diversify in terms of their investment base, and that's underway. Those are the two key theses. Third is, of course, our sense is commodity prices generally will remain benign. Energy prices particularly have remained benign. What has not been benign lately, and that's the highlight of the last month, is that the aluminum prices have actually started moving up, and aluminum prices have gone to 28 50 dollar, which is clearly one of the highlights. It's also the tightness on the supply side and what China is doing on the supply side, which is driving the prices on the commodity side. So commodities is something that one should watch out for in terms of the impact more from the supply side, given that the demand is likely to remain benign. But that's where we are, and that's an interesting actually part of the global markets, which we are also looking at very carefully. So that's where we are on the global front. Domestically, macros remain benign. In fact, macros in terms of particularly the data point on inflation continues to hit lower numbers. CPI last month was lower than 2%, which is the lowest number we have seen probably in 8-9 years, 8.5 years to be precise. This is the lowest number we have seen. Clearly, the inflation in the economy has been undershooting RBI's guidances, and while we can be happy about it, from equities perspective, it is also a challenge, because from a macroeconomic stability perspective, a control on lower inflation is good, but from a nominal GDP growth rate perspective or growth perspective, too low inflation is not good, and that's where I said that as an equity investor, I should be more worried about inflation actually hitting 2% than being happy that it provides macroeconomic stability. I don't think macroeconomic stability in India at this point in time is a challenge when you look at internal factors, external factors, right from forex to current account deficit to inflation to balance sheets, bank balance sheets, real estate balance sheets, corporate balance sheets, banking credit cost. Most of the macroeconomic indicators are healthy. One indicator, tax revenue collection, of course, is moderating as your nominal GDP growth rate has been moderating as an outcome of the inflation. While the headline real GDP growth rate continues to look good, the nominal GDP growth rate has been falling for last 4 quarters because your inflation has been undershooting RBI's guidance, and that's where we are a votary of the thought process that interest rate cut should be upfronted rather than being back-ended. Given where we are still running a repo of 5.5% with a real interest rate of roughly, even if you take RBI's own projections, about 150 basis point, which is still high for a growth rate, nominal GDP growth rate, which has been undershooting effectively the long-term averages. So that's where we are in terms of macro. Another highlight clearly of macro has been, and it warrants a discussion, is our current account deficit, particularly the trade deficit. Predominantly, whatever expansion it has seen, little bit has been predominantly on account of gold imports, and gold imports continue to be very high despite the prices moving up. Just a caution for investors that gold generally is a play on uncertainty, is a play on, one should play it as an insurance. Uh, Gold started moving in calendar year 22 post Russian assets being freezed by US. As a consequence, central bankers started buying the gold. But what we are observing that incrementally, gradually, the central bankers are not the key players in gold buying, but the ETFs and private investors have become a key player in the gold buying, and that is always a challenge because then it is a speculation rather than a play on uncertainty. So one has to be careful about general flows in the gold, which have been coming right, left, center, particularly from private investors globally, not only in India, globally, and that's what is leading to the imports, and that's also showing up in our trade deficit. It is not showing up in the overall current account deficit because generally the services have been doing well for India over last 4-5 years, continues to do well. Services exports, including IT, as well as the remittances have been good, and that's where it doesn't hurt us, but it continues to warrant a very close look. So that's where we are in terms of macro. Uh, Coming to earnings, I think clearly our sense is we have bottomed out in terms of earnings. We have alluded this multiple times that between financial year 20 and 24, we got 16 to 18% CAGR earnings growth as reported. After that, financial year 25, Nifty earnings growth was high single digit, 6 to 8%, predominantly because of two factors. One, government pulling back on the incremental capex during the election, as well as the general election, as well as RBI's policies, which pulled back the credit growth from 16% to 10%. As those two factors have reversed post the September of 2024, gradually what we are observing that the capex has come back to normalized level. The RBI policies are 180-degree reversal from where they were. The liquidity is surplus. RBI has been consistently keeping liquidity surplus. The credit growth, while it is yet to reverse, but it seems to have bottomed. Just in last 1 month, we have seen a 1% of incremental credit growth, actually moving up from 9.5% to 10.5%. Our sense is that credit growth will actually move back a little bit more, given that RBI, both from administrative perspective, liquidity perspective, has been supportive of credit growth against the worry about the credit cost, which was very last year there. So those are the two factors which led to earnings slowing down. Gradually, what we are observing is that all those factors have reversed. The capex has normalized. RBI as policies have clearly revised. We are likely to have, not only we had 100 basis point of interest rate cut, we are likely to have another 25 to 50 basis point of interest rate cut, assuming the inflation remains where it is. On top of that, you have monsoon, which is third year in a row, very well distributed and excess. So it continues to be supportive of the rural part of the economy. The rural wage, real wage growth rates, which have been a challenge in for several quarters, has actually seems to be turning the corner gradually. And on top of that, the biggest one being, and which we have alluded partly, is the latest being GST rate cuts, which adds to about 1.5 lakh to 2 lakh crore, depending on which consensus assumption you take. The social welfare schemes by state governments about roughly 3 lakh crore rupees, and a personal tax cut in the last budget, which was about roughly 1 lakh crore rupees. When you add all these numbers, clearly roughly a stimulus of 5 lakh crore has been given by the central state governments put together, which at the margin is likely to propel the consumption part of the economy. And that has been our view since the budget. We continue to have that view that it will be a barbell market with investment, some part of the investment continuing to doing well, but a lot of smaller segments of the consumption gradually reviving. In that context, clearly this stimulus helps, and GST has been one more additional aspect in that, which is roughly 1.5 to 2 lakh crore rupees. Mind you, we're going to have one more basically push on the consumption side, which is likely to be the 8-pay commission, where the assumptions are anywhere between 2.5 to 3.5 4 lakh crore rupees of number. But that's for next financial year. So those are the aspects which have been playing, and given these drivers, a capex which has normalized, both public private capex, a banking credit growth which is normalizing, a liquidity environment which is good, a monsoon which is good, and on top of that, a consumption push or general social welfare scheme push from governments, which adds to 5 lakh crore rupees. If you add all these things put together, it is clearly reflecting in gradually the earnings. So for last, after 4 quarters in financial year 25, the earnings have gradually started turning. Last quarter was 8.5% earnings growth for Nifty as reported. This quarter, consensus is putting in numbers in and around that region. Second half, just because of sheer base effect, is likely to be good. So there is clearly a trajectory change from virtually mid single digit to mid low double digit over next 2, 3, 4 quarters. That's what the assessment is of consensus, and that's largely what we concur with. So clearly, the factors which impacted the earnings have reversed, and thus the earnings are gradually likely to reverse. Clearly, in this environment, because the last year valuations were really high to start with, and earnings disappointed, particularly the FIs have been sellers. The market has not gone anywhere. I think a lot of these excesses we have gradually been digesting, and we continue to digest. So that's where we are as of now. The large caps are trading at roughly 20 21 times 1 year forward earnings, 1.5 year forward earnings rather. The the mid cap, small caps are trading at roughly 25 to 27 times 1 year forward earnings, 1.5 year forward earnings. That's financially 27 earnings on a consensus basis. While valuations remain still a little expensive, and given the latest rally that we have seen, small rally that we have seen over last 1.5 month, uh, the valuations, while they remain expensive, finally the earnings seems to be turning the corner, and that's what market would be more interested in, and particularly the FIs would be very keen on looking at that, because while the emerging markets have done well in general, India has seen absolute outflows of 15 to 20 billion dollars over the last calendar year, and that could change if the earnings trajectory starts gradually aligning with what consensus and we are saying, which is the mid double digit earnings growth for next two financial years starting the second half. That's where we are in terms of the earnings piece. That's where we are in terms of the valuation piece. Our sense still remains that it's market where uh, valuations still remain a little expensive, but the earnings are turning the corner. So at least the one factor is turning the corner. And in that context, given where the valuations are, still you can we are constructive, but one has to be careful in terms of actually adjusting or readjusting their expectations against the previous 4 5 financial year, where people have seen much sharper or higher CAGR compounding in the market, because the earnings compounding is now likely to be mid double digit, and the starting valuations are no more on an absolute basis cheap. So that's where we are, more consolidation with upward bias as earnings play out for market. In this context, from our portfolio perspective, we are positioned in a barbell way. On industrial side or cyclical side, we are overweight uh, on the financials, on the industrials selectively. That's transmission and distribution, which is T&D, renewables, and defense. These are the three segments in industrials where we are overweight on. Financials, where banks is gradually being overweight, banks, NBFC versus the capital marketplace. Uh, then consumer discretionary, which includes auto and non-auto retail and other segments. So consumer discretionary is overweight. Within the defensives, telecom, healthcare continues to be overweight. Then smaller pieces like hotels, hospitals are overweight. Pharma is overweight. These are the parts of the economy or market where our portfolios are generally overweight. As far as the underweights are concerned, underweight is in the commodities, which is metals, and that's where I said that we are watching it very closely in terms of whether it is demand led or supply constraint led, in terms of the latest price increases that we have seen in aluminum. Whereas energy is also underweight. Energy is underweight predominantly because of the policy related uncertainty on the upstream downstream side. So energy commodities is underweight. IT still is marginal underweight, uh, given where the numbers are, and where the CAGR earnings expectation in this sector. Staples, gradually we have become equal weight in most of the portfolios, given our view on consumption. But within consumption, as of now, still auto, consumer discretionary, and the other discretionary parts of the consumption remain more overweight than the staples. So that's how the portfolios are positioned. This is largely for what has happened in last month. Just to summarize, uh, a complex global environment, but we might be exiting the challenges, or at least reducing the challenges in terms of the trade barriers as well as the geopolitics. Uh, Second, clearly, emerging markets have outperformed US for the first time after a long time. India has not been recipient of it because of the valuation earnings context. Uh, if that trend continues, and which is more likely to continue, and if our earnings change, that could be one more change that Indian investors might see, whereby FIs at least at the margin stop selling first, whether they buy or not, that the earnings trajectory will decide. On the domestic side, the macro remain external factors, internal factors remain healthy. The challenge is on growth side, and in that context, uh, probably a cut or two from RBI will only help. The additional drivers which I alluded to, right from monsoon to government support to the liquidity support by RBI to the existing cuts by the RBI, that clearly remain the drivers for the market. This is largely for the last month. We'll again have this interaction next month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.